That's kind of how we're positioning right now.
There's two characteristics that you pick out. One is high switching costs, and you can walk me through what you mean by that in a moment. And the second is recurring revenue. Where do you find those companies right now in this equity market, Judy, with both high switching costs and recurring revenue?
Well, typically software is where you look for a lot of these types of businesses. They typically can be mission critical software that you've implemented and that you're not going to rip out even in a difficult economic scenario. You could think of your ERP systems or some of the more vertical software players. But when I think of switching costs, I think of something like a company like West Pharmaceuticals, which is a drug delivery company. And so when you get your biologics approved by the FDA, the drug delivery mechanism is embedded in there. And so even if you find a supplier with lower costs, you're not going to switch over because you have to get the whole thing approved again by the FDA. Those are the types of businesses that kind of have really durable economic models where it's just really hard to get rid of them. Those are the ones that we're looking at right now.
They're the survivors. Let's talk about the losers. Judy, what do you avoid?
I continue to avoid a lot of consumer discretionary. I think retail, has obviously been in the crosshairs. That's like a well understood phenomenon. But man, I continue to be very concerned about travel. I think the numbers coming out of airlines will be pretty positive for the summer. We all know the planes have been full, right? But I think business travel is a real question mark to me. I know when I look at my own business travel, I'm doing so much less of it because so much can get done over Zoom now. I think conferences won't be the same. And business travel is what drives a lot of the profitability for these companies. You need to fill hotel rooms and airlines Monday to Friday, not just over the weekends.
Okay, Julie, this is really important. We've been talking about a shift in spending from goods to services, supporting some of the companies that you're saying maybe you shouldn't be in. What's happening with that transition from goods to services? Is it more than just a shift now? Is something else happening?
Well, I think, it's a lot of different factors, right? It's a rebound from the pandemic where people are, could only spend their money on goods, and now they're finding they're able to spend them on services. If you have a major decline in consumer confidence, I think you'll see even business services start to pull back. People will stop going to as many restaurants as they have been going, et cetera. And I think that's just a function of whether or not people think their earnings are going to be better or worse in the coming 12 months. I think a lot of consumers are realizing that there is a major headwind in a recession coming on, and that really impacts their behavior. You see that in kind of the appliances and large durable goods being softer than we had expected.
So, Judy, where does that leave Chairman Powell this Friday?
I think it's really important to be able to talk to inflation because I think you got early signs of that last week with different Fed commentators saying, I think being concerned about this rally and this concept of the pivot, they really want to be careful about the market getting ahead of them. And I don't think they're as much concerned about equity markets. I think they're much more concerned about fixed income markets because that's driving so much of demand and corporate finance, et cetera. So I think it's really important that we not get too far out ahead and think, oh, we're going to be cutting because, surely rates will have gone too quick, too fast. I think it's really critical that we focus on where we are in terms of inflation. And inflation, yes, it may have peaked, but it's still at very, very high levels. These are not really sustainable levels. We don't want to get into the stagflation that we did in the 1970s, where we just didn't do enough to kind of kill it all at once.
It reminds me of the note that Bank of America put out in the last couple of weeks. Why are we all so happy with 8.5% CPI? Julie, thank you. Really thoughtful stuff. Julie Biel there, just pushing back against this idea that this consumer is strong, resilient, because when you look at some of these statistics out there at the moment, there's some clear cracks for you across this country. On the equity market, we're unchanged on the S&P. On the Nasdaq, we're positive by about 0.1%. Coming up, US nat gas prices rising for the first time in a couple of months. They are surging now. We need to talk about gasoline prices, which have been falling too, and now starting to nudge higher.
We've been very lucky over the better part of the past 5 to 7 years, really ever since the fracking revolution back in 2015, we've been very fortunate to have low energy prices, effectively across the board.
That conversation coming up.
we've been very lucky over the better part of the past 5 to 7 years, really ever since the fracking revolution back in 2015, we've been very fortunate to have low energy prices, effectively across the board. And that is a dynamic that has very much shifted here over the course of 2022 thus far. I think not only is this going to be a headwind for the consumer, and there's a whole social aspect to this that we need to be cognizant of as well.
Democrats gearing up for midterms, embracing the recent relief at the pump. Gasoline prices actually climbing overnight after recording the longest streak of decline since 2015. We've had 70 straight days of declines. On the latest from DC, let's get to Bloomberg Government's Emily Wilkins. Hey, Emily.
Hey, Jonathan. Well, Democrats are feeling particularly good today, in part because of gas prices and in part because of some of the races that we saw last night in New York. New York, as well as Florida, did hold their primaries. I think if you're trying to get a sense of the headwinds for November, the one race that you really need to look at is that special election that occurred in New York's 19th district. It's really a swing district. It was seen as a bellwether for November, and Democrats wound up winning. And this really offsets the narrative that we're going to see a red wave, that we're going to see Republicans come into power in the House and potentially the Senate. And it gives Democrats some hope that they can potentially use the current economic situation as well as issues that really motivate their base, like abortion, and get them out to the polls and be able to get some wins. Now, of course, Republicans are still very likely to be able to take the House in November. They have historical precedent on their side. Obviously, prices at the grocery store are still pretty high, even though we're seeing prices at the pump go down. So it's going to be a very interesting November, but I think Democrats are taking a lot of hope after the election results from last night.
Gasoline prices have been coming down, of course. Natural gas prices have been going the other way, so you've got some relief at the pump and then pressure with the electricity bill. You just cannot get a break at the moment on so many of these fronts. Emily, thank you. I have to say, crude climbing over the last week or so, 94.24 on WTI Brent, $100 and about 64 cents. Later today, the president expected to announce his student debt relief plan. The details still unknown. The U.S. Education Secretary spoke on NBC on Sunday.
From day one, we've been really focused on making sure we're protecting our students and our borrowers. We know August 31st is a date that many people are waiting to hear something from. We've been talking daily about this, and I can tell you that American people will hear within the next week or so.
It won't be enough. Joining us now is Anne-Marie down in D.C. AMH, what are we expecting a little bit later?
Well, on that August 31st date, that deadline, we do expect the president to extend that moratorium to the end of the year, which former Treasury Secretary Larry Summers had called the worst idea. And then on top of that, when it comes to forgiving student debt loan payments, the president is expected to forgive about $10,000 per borrower, but that will be capped, usually around what if you make around $125,000. So the president is expected to announce this today, but Jonathan, we should note there are some more details they are keeping very close to the chest. So potentially some of this could shift. This is a tricky moment, of course, because the president is getting a lot of pressure from the left wing of the party saying that they should be forgiving a lot more in student debt. This is something he campaigned on. And then, of course, though, this comes ahead of a midterm election where he wants the youth to come out and vote. But at the same time, they are dealing with inflation and those inflationary pressures that Republicans we already see are running on.
We've talked about the earnings gap. The earnings gap between young college graduates and their counterparts without degrees. That earnings gap has been getting wider over the last few decades. Anne-Marie, as you know, and we have talked about this online and offline, the more we both look at this, the more complex we realize this situation actually is. How is the White House going to navigate that, as they are likely to get some pretty strong pushback to this idea?
Well, it's very difficult because they are not going to make everyone happy at all, no matter what direction they take. And I think there's two really key data points, Jonathan, to bring up. One of them is it comes to who actually has this student debt. One statistic, just 41% of first-time college students earn bachelor degrees in 4 years and only 59% in 6 years, meaning life happened, they had to drop out. Why did they drop out? But they're still paying for their degrees, but potentially did not get those degrees, and they're potentially not making those wages. So there's one issue. The other big issue is, of course, the average student debt owned by black individuals with bachelor degree holders is $52,000. By race, black college graduates own considerably more than others on average. These are the big issues the president is going to have to really walk a line when he's discussing this today, and that is why you're seeing the likes of the NAACP coming out and saying this is not enough. $10,000 is not enough, and it should be $50,000.
Anne-Marie, I've talked about this statistic through this morning a few times. I'd love your thoughts on it. 1 in 6 American homes have fallen behind on their utility bills. That's tragic in many ways, AMH. How do they confront this in Washington?
Well, when Jack Farchi was talking about his London bills yesterday, this is exactly what I was thinking about. Wait till the winter in the United States, because natural gas prices are going up in the U.S. You're seeing them as high as we've seen in 2008, and you're seeing this phenomenon around the world, and it could only get worse because it's a global market. And if you have Russia cutting down on Nord Stream 1 for potentially 3 days of maintenance, but maybe they're going to play politics and cut it down more, there's going to be even higher prices. The administration was able to work to get gasoline prices down and really hammer that home that they've done that, even though this is, of course, a global market and there's a lot of issues at play here. It's going to be incredibly challenging when heating bills for individuals really rise. And of course, at the same time, you still have higher rent. You still have higher food prices. So they are going to be going into the midterms potentially, if it's a bit warmer, on better footing. But come November, December, this is going to be incredibly critical for the administration to address.
It's a tough winter ahead for a lot of people, I think. Let's hope it's not that way, but it looks that way. Anne-Marie, AMH down in DC. Anne-Marie, thank you. Everybody's unchanged on the S&P 500. I want to squeeze in some sector price action. Let's get to Abby for more. Hey, Abby.
Hey, John. Well, yes, equities are unchanged. It's a real snooze fest. I know you're not supposed to say that, but we're looking at the smallest range going back to New Year's Eve of last year. Not surprisingly, most sectors are not moving all that much, but I will point out that energy is up top, up about 0.75%. That's, of course, in line with oil rising, as you have just been talking about. And relative to the day, bigger moves in the retail sector, mixed moves, as you can see. Peloton, the big winner on that news that they're selling their bikes and apparel through Amazon.
Abby, thank you. You can call it what it is, a snooze fest. We'll get you the trading diary. Up next.
This is Bloomberg.
Equities unchanged. Here's your trading diary. Pending US home sales at the top of the hour. US GDP and another round of jobless claims on Thursday. Plus the Fed's annual Jackson Hole get-together in Wyoming kicking off. We'll hear from Chairman Powell on Friday. And we round out the week with a host of economic data and the team. Myself and Lisa and Tom and Kathleen Hayes and Mike McKee in Jackson Hole for you over the next couple of days. From New York, this is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on Wednesday, August 24th. Here are the top market stories we are following for you at this hour. All hail the king. The dollar continues to dominate as currencies weaken across the Atlantic and Jackson Hole draws closer. How much farther can the greenback go? Housing hobbled. A string of data points to a softening in the housing market with fresh figures crossing the wire now. We'll assess the bite of higher mortgage rates with Bess Friedman of Brown Harris Stevens. And remembering Robertson. We'll discuss the legacy of hedge fund titan Julian Robertson with one of his Tiger Cubs, John Griffin of Blue Ridge Capital. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. And Guy, I promised more housing data. We have it now.
We certainly do. And in some ways, the month-on-month figure actually doesn't look quite as bleak as the market was anticipating, economists were anticipating. So the month-on-month number is negative 1%. The market was looking for negative 2.6. The prior number, remember, negative 8.6, which has actually been revised to negative 8.9. But that does take the pending home sales non-seasonally adjusted year-on-year number, Kaylee, to negative 22.5. We are certainly seeing a slowdown in the housing market, and we saw that with the earlier data, the newer side of the market, and what is happening in the more established side of the market kind of is similar. Slight differences, but basically we're seeing the same trend, i.e. this is a housing market that's slowing down. We'll talk more about this later on. This is in some ways what the Fed wants to see. Talking of which, we are now just days away from Jackson Hole. I have seen Mike McKee in a cowboy hat. That tells you how close we are to Jackson Hole. And Kayleigh, to be honest, he makes it look good.
Of course he does. Was there a bolo tie involved as well?
Was there a what? No, I didn't see.
Tie.
No, I didn't. No, no, I didn't see that. But okay. I imagine Tom Keene will be rocking one of those later on this week. John Ferro, I'm not quite so sure about, and Lisa's far too smart for that kind of thing. But this is the narrative that we're going to be watching out for. And you do feel kind of the market is in stasis ahead of this meeting. Federal Reserve Bank of Minneapolis, President Neel Kashkari, traditionally a dove. Not so much anymore. He continues to beat the drum for the need for tighter monetary policy. He spoke yesterday at a gathering at the Wharton Club.
With inflation this high, I'm in the mode of we need to err on making sure we're getting inflation down and only relax when we see compelling evidence that inflation is well on its way back down to 2%.
Kashkari, the bear. And I imagine there may be a few bears out at Jackson Hole as well. I've already seen the bear camp, though I think that was Alaska. Kayleigh, the dollar, as you say at the top, continues to push higher. We are seeing the euro fall to fresh 20-year lows on the escalating energy crisis. So our question today, and it's a well-worn one, and it's one we've done before, but I still think it is relevant, Kayleigh. Where does the buck stop? Let's ask that question to our markets editor, Christina Aquino, who is fresh back from New York, and Marcus Ashworth from Bloomberg Opinion, who's not just back from New York. He is tucked up nicely in the Surrey Hills. Christine, let me start with you. Where does the buck stop? You must have seen the advantages or the disadvantages of the dollar over the last few months.
Absolutely, Guy. I mean, I was over there ruining the weakness of the pound just because my purchasing power is that much weaker every time I have to go to the grocery store. But coming back on the other side of the pond now, you really start to understand why the dollar has powered higher like it did. And it really is because of this perception that the ECB and the BOE just can't do the same amount of tightening or as aggressive of tightening as the Fed has. And that really is what's stopping the pound and euro in its tracks, and therefore, conversely, powering the dollar higher, even though we get some signs of weakness in the housing market, as you say, and some signs of weaker economic data here and there. It really is difficult to kind of just stand in the way of that dollar powering higher, primarily because of what the Fed has done and what it's going to be doing moving forward.
Marcus, are we really talking about dollar strength here or just weakness of the euro and everything else?
It's all about the dollar. It always has been, and I think it will be for quite some while. And it's really up to perhaps Jackson Hole in the sense that everyone's now expecting Powell almost has to be hawkish. Otherwise, they'll unwind all the work they tried to do the last few months since they got amongst it in March, hiking and obviously now starting QT as well. But the point here is that, you know, they're always going to have to do 75 basis points in the next meeting because, again, if they go 50, everyone's going to say, look, there's a dovish pivot, and bond yields will collapse and the financial conditions will ease to a level which will not enable them to say they're getting a grip on inflation. So they're sort of in a problem of their own making here.
Yeah. Marcus, is this really about rates, though? Is this really about the ECB and the Fed? I read Kit Jukes' note from SocGen a little bit earlier on this morning, and he firmly puts the reason for the euro weakness at the moment as a terms of trade crisis. It's about energy. And this is one of the quotes from that note this morning. As long as the energy crisis lasts, the euro will be anchored. I can't see, he goes on to say, a significant rebound for any European currency until we get through the gas crisis. Marcus, is this really about rates? Or is this really about energy and trade?
Well, it's about the strength of the economy. The US economy is super strong, bar those housing data, which is simply a function of higher rates. The Fed is expected, if it's going 75 basis points, and the most the ECB or the Bank of England can do is another 50, by definition the gap's going to get wider and wider. Up goes the dollar. But again, it's the economies. The European economy is at a level where it simply can't handle too many rate hikes because of this gas crisis. And likewise, probably the UK economy, maybe a little bit more, but certainly the US economy can and should probably have to handle much higher rates in here, up close to 4%. So by definition, it's both, but one begets the other. And until really you see I suppose the Fed calming off and actually looking to that dovish pivot, then a bit likewise with the gas crisis in Europe, nothing's going to change. The dollar's going to keep on going up.
And if the dollar keeps on going up, Christine, what's the read-through likely to be in other asset classes?
Well, Kaylee, that's definitely going to inflict some pain on U.S. corporates. You might remember from the last couple of earnings seasons, we definitely got complaints from the likes of Microsoft and other blue chip companies talking about how the strength of the dollar is really eating into their overseas profits now. Yeah. And, you know, that's also a function of those tightening of financial conditions that Jay Powell really wants to see, right? And so that could also feed back into the monetary policy loop because, again, the Fed has insisted it's data dependent. They're definitely watching all sorts of measures of financial conditions, the dollar being one of them, a very important signal. And so once we kind of see that, or if we keep kind of seeing that, the dollar powering higher, then that could be very informative for Jay Powell and the rest of the Federal Reserve in terms of how much they're going to do moving.
I hear what you're saying about US corporates, and they're complaining about the fact they have translated earnings issues right now. But nevertheless, are we going to get to the point where the strong dollar does damage to the US economy? How far away are we from there, and how does the Fed react when we get there?
Yeah, very good question, Guy. And I think we're not very far, or rather, we're not very close at this point in time, because I think there's still enough strength left in the U.S. economy, especially when you're looking at some of these consumer indicators, especially when compared to what we're seeing here in the U.K. and in Europe as well. And I think that really is the story here is it's not just the dollar moving in a vacuum, but it's that comparative strength relative to some of its key trading partners and some of its kind of key equivalents in the G10 space. It's really hard to see any of these other currencies kind of rivaling what we're seeing in the dollar at the moment, just given what we're seeing in terms of the macroeconomic environment.
All right, Christine Aquino, thank you so much for joining us, and to Marcus Ashworth of Bloomberg Opinion as well. Appreciate the insights from both of you. Coming up, we're inching closer to Jackson Hole. Cowboy hats at the ready. We'll look for clues from the Federal Reserve and what exactly investors will be watching from that symposium in Wyoming. Katrina Dudley, Franklin Mutual Advisors investment strategist and portfolio manager, will join us next to discuss. This is Bloomberg.
This week, as the world watches inflation rise, employment rebound, and fiscal policies react. All roads lead to Jackson Hole for the Kansas City Fed's 2022 Economic Policy Symposium. Bloomberg's all-star team is live as policymakers and financial insiders discuss the economic issues and solutions that keep the world's money moving. Coverage starts August 25th on Bloomberg Television and Radio.
Some breaking news from Washington. Bloomberg reporting that President Biden today is set to freeze the student loan repayment for 4 more months. Of course, that moratorium has been set to expire on August 31st, but we understand from our reporting, according to people familiar with the matter, that pause will now run through December 31st, and that will be the final one that President Biden backs, according to sources familiar. We are also expecting to hear from the president himself at some point today on this student loan issue that he's been debating for some time. It is also expected, this package, to include debt relief to a certain extent, at least for individuals within a certain income bracket. So again, Guy, President Biden set to freeze that student loan repayment for another 4 months.
As you say, on its own, this isn't very much. There is an expectation that he will do significantly more. 10,000 may not be enough for a lot of people. There's certainly a sense, certainly to the left of the Democratic Party, that maybe more needs to be done, maybe total forgiveness. But then you have to worry, Kayleigh, about what that could do to the inflation narrative. Basically, this could be inflationary. You've got to balance those two risks out. And where does that pivot point come, I think, is going to be the really tricky thing for the White House. But I think the president's in a really tricky spot here. He's kind of damned if he does and damned if he doesn't. I think he's going to face flack from both quarters, regardless of almost what he does here. Yeah, and the inflation issue is one that has been raised, for example, by former Treasury Secretary Larry Summers. And of course, that feeds right into not just fiscal policy, but monetary policy as well. Whatever happens with inflation has implications for the Federal Reserve. So on that note, we want to turn and look ahead to Jackson Hole. Bloomberg guest has been weighing in on their expectations ahead of that symposium, and that is where all eyes are going to be on the future of monetary policy.
This is a market that is still pricing in interest rate cuts in 2023.
There are some signs now that the economy is, at least on some fronts, beginning to slow down, and that's exactly the goal that they're trying to achieve.
What is clear is that market expectations remain reasonably anchored. If they go too far, then I worry.
Inflation proves persistent. The Fed has to do the work of bringing it down, which means those policy rates need to move above 4%.
Joining us now to discuss how all of this factors into the markets is Katrina Dudley, Franklin Mutual Advisors investment strategist and portfolio manager. So Katrina, how much power does Jerome Powell have on Friday to move this equity market?
I think it really comes down to expectations of what Jerome Powell's going to talk about on Friday. I think about half the market thinks he may become more hawkish, and about half the market thinks that he's going to kind of just keep the course. But I think the interesting thing to be observing is how far we've come since the last Jackson Hole symposium. I mean, when we look back at what we were talking about then, we were looking at inflation. We were talking about why it was going to be transitory. Fast forward to today, we now seem to be accepting that a lot of these inflationary pressures are much more structural. So the Fed now is walking a very, very fine line between the need for price stability and the fears of a U.S. recession that could happen if we continue tightening with this high inflation.
The problem here, Katrina, is that policy works with a lag. And as a result of which the Fed has got, as you say, tread very carefully to see exactly what impact policy is having. We're already starting to see it maybe showing up, though, in the housing market. We've had a series of data this week that are certainly pointing to a significant slowdown. Is that a controlled slowdown? And what do you think of housing as an investment?
The housing market to me is fascinating. I think you've got two parts of the market. The first is the existing home market that people very much are focused on, and you would expect a slowing of that as people are stuck in their houses because they've financed them with such low mortgage rates, and for them to transact, they actually have to go into a much higher, cost product. So I think that people will be much more inclined to stay where they are, and that's actually good for, say, home improvement demand as people fix up their existing homes versus moving moving up the scale. In terms of the new home buyer market, which is a real driver of those home building stocks, what we're seeing is just people taking a step back and digesting higher interest rates, obviously higher the higher house prices, and some stock market volatility and a little bit of these recession fears. But if you look at what Toll Brothers was saying, they're a high-end builder, it looks like some of those orders actually came back in August. So we've just gone through an adjustment period, and we look at the undersupply of that housing market, and we're very bullish on what could happen going forward.
Katrina, as we talk about the U.S. economy, obviously the picture here is very different than the picture where Guy is in London or in broader Europe. The other side of the Atlantic, the situation is looking a lot more fragile. Is the U.S. the only place you can invest right now?
I would say that our perception is Europe is a lot more fragile. I just came back from there, and it is very, very robust as an economy. People are there. There are a lot of Americans there at the moment, probably taking advantage of the strong dollar and the weak euro as well. So I don't think that the European economy is quite as fragile as we think. Obviously, the PMI data that's just come in is slightly negative, but I think we are looking at signs of the energy security issue being controlled and being adjusted for. We're not seeing those Armageddon scenarios being talked about as much. The big risk at the moment is, for example, in Germany, those low levels of the Rhine, which could further disrupt manufacturing, and we've seen that happen in the past. But I actually think that the European economy is a little stronger than we perceive it to be from, over here in the United States.
Are you putting money behind that, Katrina?
We have an overweight position in Europe, so I think that our portfolio reflects our views and the positive outcomes there. I also think that we look at valuations in Europe, and that the gap has compressed, but they continue to be cheaper on a number of metrics for various different stocks. So we've got opportunities to buy these European companies at good valuations. We still are finding opportunities in the U.S. I think you really, though, need to take a view on certain markets and certain sectors that is slightly different from what consensus is telling you.
Katrina, always great to catch up. Thank you very much indeed. Katrina Dudley of Franklin Mutual Advisors. Great stuff. I want to get back to the breaking news that we brought you just a few moments ago. President Biden, we now understand, looks like he is set to freeze student loan repayments for 4 more months. That would be the 7th extension. The question is, what else is he going to do? Is there going to be $10,000 of money coming off those student loans? Is it going to be 20? What's the inflationary impact of all of this? Anne-Marie Jourdain, Bloomberg's Washington correspondent, joining us now with more. Anne-Marie, normally this stuff would have been leaked. The fact that we are so close potentially to an announcement and we don't know seems to imply to me that maybe decisions haven't been made yet, that this is going right to the wire.
Well, they've been keeping this incredibly close to the chest for months because they just didn't have the decision in hand, because they are being lots of debates within the administration, but also being courted by different parts of the party about which avenue they should go to, because when you have news that it's only going to be potentially $10,000 per student borrower, that is not enough for the very progressive wing of the party that want to see a lot more in sort of loan forgiveness. What we do have, and Bloomberg News is reporting, is that we are going to get what we expected, which is the extension of this that was supposed to be from August 31st. It'll now go for 4 months, the pause on repaying that debt, and that started during the COVID-19 pandemic under the former President Trump. The other piece of news we are getting that the Washington Post is reporting is that the White House is considering, potentially an announcement today, about $20,000 in debt for Pell Grant recipients. Guy, you live in the UK. I'll quickly explain what Pell Grants are. This is money for those on the very low income stature in the United States, and to make sure that those individuals can apply and to go on to secondary education, and they don't need to be paid back, but those individuals may still have to take out loans. So potentially they are going to get a higher chunk. If maybe it's $10,000 for everyone under a certain cap, those Pell Grant potentially might be getting $20K.
All right, well, we will look forward to your updates throughout the day today. Bloomberg's Anne-Marie Jourdain in Washington, thank you so much. This is Bloomberg. Bloomberg.com. Shares of Nordstrom are falling after the upscale department store chain cut its full-year outlook. The results show how consumers are pulling back as inflation starts to pinch. For more on retail's winners and losers, Stephanie Wissing, Jefferies senior research analyst, joins us now. She has a hold rating on Nordstrom and a $21 price target. Stephanie, maybe you can help me figure this out. You had Macy's yesterday cutting its outlook, talking about inventory problems. Nordstrom doing the same thing, and yet the recipients they have received in the market very, very different. What went so badly for Nordstrom that didn't seem to go off that badly for Macy's?
Yeah, I mean, it's a game of expectation. So clearly Macy's had done a good job coming into the quarter by hedging some of that downside. I think the expectation for Nordstrom was that it was going to be an outlier to the positive. And the numbers at the headline level weren't terrible. It was that guidance that really shook everybody. And I think some of the commentary that started to underpin that maybe the inflation pressure is not just isolated at the low or bottom end of the middle income range, that it's now starting to sneak up into that higher middle income level. And that was probably the thing I think that's shaking people the most today with Nordstrom specifically. The other thing they called out was anniversary sale was up 5% year over year, and that did miss their expectations. And that tends to be a proxy for fall fashion more broadly across retail. So slight miss there on the anniversary sale, I think also is creating some consternation today.
Stephanie, can I just ask you a slightly, it maybe is a left field question, but it's just related to the news that we just got. If we see significant student loan forgiveness from the president today, would that be a positive for retailers? How do you think that would work in terms of how quickly it would flow into the economy, into the retailers?
Yeah, I think if this was the first motion of forgiveness, we would start to calculate what we think it could be in terms of a tailwind. But this is an extension of a multi-year forgiveness cycle and conversation. And so this really just defers for a few more months. You know, we won't really know until we get to the back half of the year whether this is going to be something that's more significant in terms of overall forgiveness or give back. But I would say today, when we look at that millennial Gen Z cohort, it's a very powerful cohort in the broader consumer economy. But I don't think that this announcement today is necessarily going to change their spending patterns in the immediate term, because it's just deferring what could be a reality of repayment starting in the early part of next year.
But obviously there is an income bracket component to this, and you were mentioning earlier kind of the vulnerability of the middle income bracket. What retailers are most vulnerable to that softness?
Yeah, Kayla, this is a great question because there's two parts to the question embedded. The first is that when we were thinking about recession initially, we were thinking about the low-income consumer being really bearing the brunt of the recession. But now you have Kohl's, Macy's, and Nordstrom all signaling that that middle income is getting squeezed. And I would even throw Walmart and Target in there a little bit too, based on what they talked about in terms of cohorts, that it's not necessarily a low income recession. It's more of a middle income recession on the good side that we're seeing right now. So that was one of the common threads across Kohl's, Macy's, and Nordstrom this earnings cycle, is that they all talked about that middle being most under pressure versus the low end. Low end seems to be holding up okay in terms of wage growth, but there is definitely some behavioral shifts that are happening around gas prices and food inflation. But the middle is the one that seems to be the most vulnerable right now.
Yep. The squeeze middle. Stephanie, thank you very much indeed. Stephanie Wissing, Jefferies senior research analyst, thank you very much indeed. Coming up, we're going to look at Julian Robinson's legacy. Tiger Cub John Griffin is going to be joining us. This is Bloomberg.
The economic fallout is. We're an hour into the U.S. trading session. Bloomberg's Abigail Doolittle is tracking the moves. And Abigail, we're higher, but I noticed volume is really light.
Volume is very light. We do have these gains. The S&P 500 up about 0.3%. But volume, to your point, Kaylee, it is well below. At one point, it was 30% below the 20-day average. That says a lot given the fact that we're in the middle of the summer, so a true summer day. I'm not sure if this is still true, but this might be the smallest range since New Year's Eve of last year. So we are truly in that summer trading type of period. You can see the dollar up just a little bit. The bigger move probably is in the bond markets. You have bonds selling off to some degree, yields higher. This, of course, ahead of Jackson Hole with Fed Chair Jay Powell's anticipated speech on Friday. The big tell, folks waiting to see just how hawkish he is, or will there be some sort of a dovish surprise? Most folks are saying that he'll probably be more dovish, or excuse me, hawkish than expected. As for energy, one area of real strength is the energy sector. This is over the last 2 weeks, and in white we're looking at the energy sector. In orange we're looking at crude oil, which you can see really has rebounded now closer to $93 or $94 per barrel. The S&P 500 over this time period down just slightly, so the rally we had out of the June 16th low, it is coming off. But take a look at that energy sector, up about 9.5%. This, of course, as natural gas has been soaring. Not soaring, though, pending home sales, the housing market really in a recession. This is the pending home sales, and you can see that for many months now, it has mainly been to the downside. This, of course, is a leading indicator. Toll Brothers, a luxury home builder, yesterday reported they cut their sales outlook for the year. Home orders down by 60%. So the forward pull for housing here in the U.S. as rates go higher, not very good. This is something to certainly keep an eye on relative to the economy. And also, of course, Guy, for the economy, let's take a look at retailing, what we have going on here. Nordstrom down 18.2%. They cut the outlook, of course. The Rack, their discount arm, really had some weakness there, bloated inventories as lower income consumers relative to lower income for Nordstrom really fell off in June into July. Less traffic, less demand, so they're discounting to sell that product, and you can see it's really pulling on the rest of the consumer space. Although, Guy, we have a little bit of a bright spot here. Ralph Lauren now slightly higher.
Great stuff. Abigail, thank you very much indeed. We're in the quiet period now, it seems, ahead of Jackson Hole. Volumes incredibly light ahead of that speech Friday by Jay Powell. Tributes are pouring in following the death of the billionaire hedge fund investor Julian Robinson. The founder of Tiger Management trained a large number of successful managers who were dubbed the Tiger Cubs. We are now joined by one of them, John Griffin, Blue Ridge Capital founder and Robin Hood Foundation chairman. John, thank you very much indeed for your time today. This man was a legend on Wall Street. How would you describe him as a man? What is his legacy? How do you think about him?
Well, I do think about him as the man, as a man with incredible passion, incredible generosity, a real desire to mentor people, me being a lucky recipient. But I think he'll be most remembered as the founding father of the modern long-short hedge fund. I mean, he started in May of 1980. There obviously have been funds, before, but Julian made it an art form. I think he'll also be remembered for hiring young people who had very little experience. Julian wanted to train them himself. He wanted to get people who, like him, were passionate about the business, and then mentor them. And that's his legacy. Maybe 200 Cubs or more.
Yeah, and as we said, you are one of them, John. You talked about how Tiger Management was founded in 1980. 40 years on, we're in a very different place, and yet there are some parallels from this time and that time. I'm wondering how the model that he helped make famous really still can work today. How much of those investment theories still hold true?
Right. I think it's a great question. I think when Tiger was at its best, it was finding longs and shorts that would work out over a long period of time. And I think that period of time has extended. But one thing Julian was great at was getting to the sort of kernel of what is going to make the investment successful or not, and focusing on it. So he kept it relatively simple. Here are our longs, here are our shorts. These were great companies that over the long term were going to create an enormous amount of shareholder value. And here were the shorts. Given enough time, we're going to go down an enormous amount, maybe to zero. I'd say even while I was at Tiger, at least 30 or 40 shorts were delisted and went all the way to zero. That I don't think has changed.
There are a number of greats out there. Soros, Steinhardt, Robinson fits into that bracket as well. In terms of the investment strategies that they had, the way that they approached the market, John, what do you think separated them from the rest of the pack?
Yeah, I think Julian was separate from those other managers. I think what separated Julian was a deep he had a deep focus on bottoms-up fundamental analysis of a company. What is going to make this company succeed or this fail? And he did it in a relatively innovative way. Instead of reading research reports, he would call everybody. He had, as you heard from so many tributes, just an enormous amount of energy for calling and asking about companies, and who he'd call are customers, competitors, suppliers, maybe former employees. And, you know, back then, you know, in the 1980s, this type of research wasn't being done. It was mostly sell-side research and access to management. And I think Julian really innovated on doing what we came to call a value-added research, away from the types of research others were doing.
So that is the man as the investor. Let's talk just for a moment longer about the man as a philanthropist. What do you see the lasting legacy of his role in philanthropy in the Robin Hood Foundation?
Right. So, and the way they're related is in 1990, Julian sent me down to see Paul Jones, who was all of 33 years old and had founded Robin Hood in 1988. And Paul said, hey, why don't we just join forces? I went back and told Julian, and in typical Julian fashion, well, that is very kind of Paul, but I think we should do it our way. And I said, okay, Julian, what's our way? He goes, well, why don't we take the same approach we are to companies and apply them to not-for-profit organizations? Why don't we actually have the analysts go out and meet and research and take the same sort of, you know, very detailed bottoms-up approach to decide what not-for-profits we should fund? Education was always a big area for Julian. So Julian's was, who is doing the most in education? This led us to KIPP, this led us to Teach for America, Success Academies, and many others. But it was a different approach. The analysts actually did the work, and we voted and made the philanthropic decisions, which was very unusual at the time.
John, you bring up education, so let's just talk about the news of the day. The president potentially poised to deliver some student forgiveness when it comes to student loans. How far do you think he should go? How do we fix the education system in the United States?
What a question. How much time do we have? We have been asking that question for a very long time in terms of fixing education. I will add not a solution, but just an urgency. We must. I mean, it is something that is the greatest avenue for people to change their circumstances. It's the great calling in the United States that someone can come with no education and no money and through education change their lives. In terms of the actual solution, I won't be able to give it to you.
They take on so much debt in the process of doing that. Is that right? And do you think it's now right that the president should step in and forgive some of it?
I think lower debt is good in general for students. Having said that, if we have a great education system, the debt they take on will be the greatest investment they ever make. I do agree with Warren Buffett, who would always ask, what's the best investment I can make? He says, in yourself. I think with the right education and moderate debt, as long as the education's right, there will never be a higher return on investment than a proper education.
Well, and of course, you have a hand in educating students still, teaching at the great University of Virginia. Might I say, go Hoos. John, just as we were talking, we did get the headline crossing the terminal. Bloomberg now reporting that Biden will be forgiving $10,000 in student debt, $20,000 for Pell Grant recipients. This is at a time when the president is hyper-focused on inflation and bringing inflation down. There has been arguments made on one side that this is only going to add to those price pressures. What is your read now on inflation's trajectory? How far we are away from the peak? Have we peaked? And what does the descent look like?
Another great question. You lost me at Wahoo Wah. No, I wish I had something I could share with your viewers on inflation, other than the fact that we haven't seen an inflation cycle in a long period of time. I came to Wall Street and joined Tiger in 1987, and the 10-year rate was very high. Inflation was sort of part of our lives, but we've been in a disinflationary situation my entire career on Wall Street. So my point is, I'm waiting, watching. I'm trying not to predict. It is a new environment. But I do believe right now valuations of many great companies are reasonable, and buying great companies at reasonable valuations, holding them for a long period of time, has been a winner's game in the United States since the stock market started, and that's how I'm personally positioned.
How are you going to outperform, John? What is the secret sauce in this new environment?
I think it's duration. I think taking advantage of short-term swings, buying great companies when they get killed and left for dead, or somebody's worried about Jackson Hole, adding to them, and then selectively trimming them when we're back in our next optimistic scenario. An optimistic barometer I've always used is new listings. When the SPACs and IPO market was extremely heated, that is almost always a time for caution as a long-term equity holder. So my answer to your question is, you outperform by buying great companies when people are panicky and selling them when they're very self-satisfied and lots of IPOs.
Buy low, sell high. In terms of how you see the environment being different, though, John, QE, which has been with us for a very long time now, we've seen money flooding into the system from central banks. We've created a lot of money. It has created a lot of millionaires. It's created a lot of billionaires. We are now going into the opposites of QE. We're going to be tightening, QT. Does the opposite apply? Are we going to see wealth destruction rather than wealth creation as QE generated?
Absolutely, but I think we've seen a lot of it. I mean, if you add up the amount of wealth destruction in equity markets, take away the S&P, but let's use what people call sort of unprofitable but high-growth tech, which was a large part of the market. We've seen a lot of that. So yes, I agree with both your observation and analysis. I can't tell you when it's going to end. Certainly there could be more, but we've already been through some amount. And from that destruction will come the founding of great companies. Living through the internet bubble and bust, as you know, during the bust, some of the greatest companies of all time were started. And that's likely happening now.
All right, John Griffin, Blue Ridge Capital founder and Robinhood Foundation chairman, thank you so much for joining us with your insights as well as your reflections on the legacy of Julian Robertson. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Rishika Gupta. President Biden is set to announce a 4-month extension of the moratorium on repaying student loan debt. It's part of a broader package that is also expected to include debt forgiveness. $10,000 in student debt will be forgiven, $20,000 if the student received a Pell Grant. President Biden says he's proud to announce the U.S. is giving almost $3 billion more in weapons to Ukraine. The announcement came on the day Ukraine celebrates its independence. It's also the 6-month anniversary of the day Russia invaded. And about 1 in 6 American homes, 20 million households, have fallen behind on their utility bills and face the possibility of a shutoff. According to the National Energy Assistance Directors Association, it's the worst crisis the group has ever documented. There's been a big surge in electricity prices propelled by the soaring cost of natural gas. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg Guy.
Rika, thank you very much indeed. Numbers down today underscore the sharp downturn that we are now seeing in the U.S. housing market. Pending home sales fell last month to the lowest level since the start of the pandemic. Joining us now, Bess Freeman, the CEO of Brown Harris Stevens. It's one of the largest privately held real estate companies in the United States, for a bit of context. Bess, thank you very much indeed for joining us. What are you seeing on the ground right now? What is your experience of the current housing market?
Good morning. So good to see you. I think we're starting to see some normalization. Things are starting to be more balanced. What was the pandemic housing boom of 2021 has officially left the building, I would say. That sort of irrational exuberance that we saw is gone, and we're seeing, rates went up. So naturally, applications are down. We saw that come out this morning. Contracts are down. There were 8 signed last week, over $4 million here in New York, which is low, considering. And so I think we're seeing a bit of a slowing down, but it's contextual because there's incredible opportunity in prices. So if your rate is a little higher, I think you can negotiate better on buying a home. But I do think, markets, as Warren Buffett says, markets are here to serve us, not instruct us. Mm-hmm. And I think based on people's circumstances, they're still going to have to buy and sell and rent, et cetera. It just depends on what's going on.
Yeah.
And so it's not crazy. It's not the end of the world at all.
Okay, well, Bess, if I'm a buyer, I'm going to swallow that higher mortgage rate, maybe try and use some negotiating power. Are there houses available for me? I mean, how much more balanced is supply with demand now?
It depends. I mean, not all square feet are created equally. Where are you buying? Are you buying in Connecticut, in Greenwich? There's not a lot of supply and prices are high. Palm Beach, again, another place where we have very little supply. Are you buying in New York City on the Upper East Side? There's a decent amount of supply here and you can negotiate. So it depends on where you're looking. I mean, real estate is so local. You can't just throw a blanket over it and say, it's this or that. It depends on where it is because supply and demand fluctuates. And certain markets have ample supply and certain markets have very little supply, and that has been that way since the pandemic. Palm Beach is one of those markets that has truly suffered for a lack of supply. And people want to be there, people want to invest there, but there's so little to purchase. So New York City is your place to buy if that's where you want to